In this video, we'll use the 2024 annual report of Dr. Martens plc to calculate efficiency ratios. The inventory turnover period calculates the period of time the company holds stock for. This is calculated by dividing the inventories held by the cost of sales, then multiplying by 365. Some analysts may use average values on the numerator of this fraction, using the average of the opening and closing values for stock. Others may use the year-end value, and that's the approach I'm going to take. Whichever approach you use, you must be consistent. Cost of sales is easily found on the profit and loss account. Using these figures, we can see that the inventory turnover period has gone from a period of 246.2 days in financial year 23 to 307.8 days in financial year 24. So it's taking the company 307.8 days to turn the raw materials into a sale. That's a long time, and it's got considerably longer in financial year 24. The type of product sold does mean that it can be held for a long time without becoming obsolete, but there are costs of holding on to stock for such a long time. Also, if consumer tastes change and demand for some product styles decreases, there is a risk that the company may be holding on to stock which won't sell. On reviewing some information available on the DM website, there is a comment that there were additional storage costs in relation to temporary storage in the Americas due to elevated inventory levels in that market. Dr. Marten also state that they have reduced purchases for financial year 25 to try to reduce inventory. We therefore expect to see a reduction in the inventory turnover period in financial year 25. This ratio is a good one to compare with a competitor company and then investigate any differences. The accounts receivable collection period is the period of time it takes the company from making a sale on credit to collecting the cash from the customer. This is calculated by dividing the accounts receivable by the amount of sales on credit, then multiplying by 365. The Statement of Financial Position Current Assets section includes a figure for trade and other receivables. I only want to include trade receivables, so I'll refer to the note reference given on the Statement of Financial Position. Here you can see the trade receivables figure, less what they've called an allowance for expected credit losses, which is the same as a bad debt provision, and this gives us a figure for net trade receivables. This is the one I'll use in our calculation. On the denominator, we need credit sales. It's often the case that we don't know the split between credit and cash sales, so for simplicity, we can use the total sales figure. As long as we're consistent, we can make comparisons with previous year's figures. The collection period was 28.8 days in financial year 23, dropping to 22.6 days in financial year 24. A drop in this ratio is generally a positive thing. The company is collecting the amounts due more quickly and can therefore use this cash elsewhere in the business. It's important to compare the result with the credit terms offered, competitors' amounts, and industry averages. The accounts payable payment period is the period of time it takes the company to pay the suppliers it bought from on credit. This is calculated by dividing the accounts payable by the cost of sales, then multiplying by 365. The cost of sales figure is easily found in the profit and loss account. The figure included in current liabilities on the Statement of Financial Position relates to trade and other payables, so we need to look at the note giving more information on this. From here, I will select the figure for trade payables. In financial year 23, the payment period was 61.3 days. This has dropped to 39.9 days in financial year 24. This means that Dr. Marten is paying its suppliers more quickly than in the previous year. In general, paying more quickly is a bad thing from a cash flow perspective. A company should take full advantage of payment terms offered. However, a company shouldn't take longer to pay than the terms they've been offered, as this may damage their relationship with suppliers, which may impact future supplies. We need to compare the payment period with the terms offered. Unfortunately, this isn't information we can get from the annual report. We could also compare this to the payment period of a competitor, particularly one who's likely to use similar suppliers. Looking at a summary of these ratios, the movements in the inventory turnover period and payables payment period are potentially not good. The movement in the receivables collection period is possibly positive, although we need more information on the credit period offered to customers.